Welcome back to Investing Talk Podcast. Today we are getting into the very volatile situation around Quantumscape. And the big question, really, that our sources try to tackle for you is, well, it's simple, but kind of loaded. Is this company, this pre-revenue powerhouse with amazing battery tech, is now a good time to buy shares?
That really is the multi-billion-dollar question, isn't it? When you look at the material, you see this classic investment paradox. How can a company with absolutely zero commercial sales be worth billions? And why is its stock suddenly shooting up? That tension, that gap between the tech promise and the cold financial facts, that's what we need to unpack for you.
Absolutely. It's all about that future potential versus the present reality, or lack thereof in terms of revenue. Now, before we dig into all that, if you find this discussion useful, please take a moment to subscribe, like the video, leave a comment, and definitely, if there's a specific company you'd like us to examine next, please let us know in the comments below. We do read them. Okay, so let's start with the excitement, the momentum, because, you don't see a stock surge 152% year-to-date without something happening. It climbed from a low of about $3.40 to nearly $13.61 recently as of September 2025. That's huge.
It is, and it's all centered on their core tech. Quantumscape is all about solid-state lithium metal batteries.
Right.
And this isn't just like a small improvement. It could be the holy grail for electric vehicles. We're talking higher energy density, much faster charging, better safety.
A potential total disruptor for the whole EV battery market.
Exactly. But potential only gets you so far if you can't actually make the stuff. And what really stood out in the sources was this recent technical news that seems to tackle that huge hurdle, scaling up.
Yes. The Cobra separator breakthrough they announced. That sounded significant. They're saying it offers, what, a 25 times improvement in production rates?
Yeah, a 25x improvement over their previous methods. And importantly, it also shrinks the physical footprint needed for the equipment.
That's key, because manufacturing scale has been the big question mark for solid state for years, hasn't it?
It really has. So that addresses a core risk.
But then came the maybe more emotional catalyst. The actual demonstration.
Right, the Ducati.
Exactly. September 2025 at the IAA Mobility event. They put their solid-state batteries into a working Ducati motorcycle. That was apparently the world's first real-world demonstration of anode-free solid-state batteries in an EV context.
And they put a number on it, which always helps.
They did. 844 watt-hours per liter.
And that number, 844 WHL, that's the crucial metric here. It directly relates to how far a vehicle can go and potentially how much the battery costs.
So how does that compare? Like, what are current batteries?
Well, today's best commercial liquid lithium-ion batteries, they generally top out around, say, 550 to maybe 650 watt-hours per liter.
Okay.
So hitting 844, that's a massive jump in energy density. You're potentially looking at 30, maybe even 50% more range.
Wow. Or you could use a smaller, lighter battery for the same range.
Exactly. Either way, it's a big deal. And that's why the market reacted so strongly to that demo.
And then there's the Volkswagen connection. You can't ignore that.
Definitely not. The extended strategic collaboration with VW's PowerCo unit.
PowerCo is VW's dedicated battery division, right?
That's right. And the partnership includes potential milestone payments up to $131 million.
When a giant like Volkswagen ties its battery future, even partly to your tech, that gives you a lot of market validation.
It absolutely does. But, and this is the big but, we have to ground ourselves in the financial reality here. Despite all the incredible engineering, the partnerships, Quantumscape currently generates zero commercial revenue. None.
Right. And that's where the danger lies, isn't it?
Yeah.
Because even a pre-revenue company has huge bills, especially one trying to build factories for this kind of tech.
Huge bills. Just look at the burn rate the sources detail. Q1 2025, the net loss was $114.4 million.
Oof. In one quarter.
Yep. And their guidance for the full year. An adjusted EBITDA loss between $250 million and $280 million.
So obviously, profit margins are way in the negative. All that money is just pouring into R&D and building out those pilot lines.
Correct. And this is really crucial for you, the listener, to understand. Success here is entirely dependent on future commercialization. There's no material revenue, no profit expected in the next year or two. It's all future tense.
How do they keep the lights on while burning through hundreds of millions?
Yeah.
This brings us to that cash paradox you mentioned. It's their lifeline.
Exactly. They actually have a surprisingly strong financial position considering the burn. End of Q1 2025, they reported $860 million in liquidity, cash and equivalents.
$860 million, okay.
And another key point, they don't have any significant debt outstanding.
So that cash pile is what's buying them the time they need to try and make this tech work at scale.
Precisely. It funds the race to production.
And the sources estimate that cash runway lasts. How long?
Based on their current spending, the projection is that it's sufficient into the second half of 2028.
Into 2028. Okay, that sounds like a decent amount of time.
It does on the surface.
But is it, I mean, given how long it takes to go from a pilot breakthrough, like that Cobra thing, to actual mass production reliably, is 2028 really enough time if they hit any big snags, technical issues, scaling problems?
That is exactly the pressure point. That's the core risk. The cash gives them the time to execute, yes, but any major delays, any big cost overruns in R&D or building factories, that could force them to raise more capital later.
Which means potentially diluting the existing shareholders quite a bit.
Dramatically, potentially. So the risk isn't really about them going bankrupt tomorrow. It's more about failing to deliver the tech commercially before that 2028 clock runs out, or needing more cash along the way.
Okay, so let's shift gears a bit and look at the technicals for the stock itself. Because the price chart is clearly not looking at those fundamentals right now.
You're kidding.
The current trend is described as strong bullish. It just reflects all that speculative excitement we talked about.
And with speculation comes volatility. Extreme volatility in this case.
Extremely high, yeah. The sources peg the stock's beta at 4.42 relative to the broader market.
Wow, 4.42. So just to translate that for listeners, if the S&P 500 moves 1%, Quantumscape stock tends to move, on average, over 4.4% in the same direction.
That's what it means. So if you're even thinking about this stock, you absolutely must be prepared for really violent price swings. About 4 times the market's general movement.
Not for the faint of heart. So looking at the charts after this big run-up, where are the key levels traders might be watching? Well, technical support seems to have formed around that $10.20 to $10.30 area.
Okay.
And the resistance, the ceiling they keep bumping up against, is roughly between $13.60 and $15. Those recent highs.
It definitely feels like a momentum play right now.
Very much so.
Okay, now this is where, for me, it gets really fascinating. This huge disconnect we see in the market. You've got, like, intense optimism from retail investors, maybe social media buzz, all driven by the tech breakthroughs. But then you look at the professional analysts, the ones digging into the financials.
Yeah, the gap is pretty stark. The analyst consensus across the board is basically a sell.
A sell, not even a hold.
Nope, a sell. And the average 12-month price target they have, it's sitting at $5.88.
Wait, hang on. $5.88. The stock is trading near $13 right now.
Exactly.
So the analysts are basically predicting the stock could fall by more than half in the next year. Just think about that disconnect for a second.
It's probably the clearest sign of just how speculative this stock is right now. The analysts are pricing in that massive commercialization risk, the huge difficulty of actually manufacturing millions of these advanced cells reliably and affordably.
While the market, or at least parts of it, seem to be pricing in the blue sky potential if the technology works perfectly at scale.
Precisely. And that disconnect itself is a major red flag for anyone assessing the risk here. So what could happen next? What could sort of break this stalemate between the cautious analysts and the hopeful market? We need to watch the upcoming milestones really closely.
Like earnings.
Yeah, the most immediate one is the Q3 earnings release. It's scheduled for October 22nd, 2025. That report's going to be critical. It'll give updates on the cash burn rate, obviously, but also any progress towards hitting those PowerCo milestone payments, which would bring in some initial, though not commercial, revenue.
And then later in the year, institutional money movements could play a big role too, right?
They certainly could. November and December often see ETF index rebalancing. Plus, we'll get the institutional 13F filings showing which big funds bought or sold shares in the previous quarter.
So if big funds start buying, that could support the price. If they sell,
would add significant downside pressure, yeah. Liquidity shifts.
And the bigger picture timeline, that commercial deployment target with VW and potentially others, that's still pegged for.
The window is still generally seen as 2026 to 2028. That's the time frame they need to hit for volume production. Okay, so for you, the listener, let's boil down the primary risks again. You really need to internalize these 3 main things. First, and it's the biggest one, commercialization risk.
Meaning they just can't make it work outside the lab.
Right. Failure to scale up that Cobra separator tech into mass production. Or maybe they hit technical problems that hurt battery performance or lifespan. Or maybe they just fail to get the big binding commercial orders they need from automakers to actually generate real revenue.
So the science might be cool, but building the factory, The reliable, profitable factory, that's the mountain they still have to climb.
That's the crux of it. Second risk, capital risk.
Even with that cash runway into 2028.
Yeah, because those are projections based on current spending. If scaling up costs way more than planned or takes longer,
They might need more cash before 2028, leading to that dilution we mentioned.
exactly. And the third risk is simply competition. This battery space is incredibly intense. Lots of smart people, lots of companies are racing to build better batteries, including other solid-state players or those working on different advanced chemistries.
So someone else could leapfrog them, even if Quantumscape's tech works.
It's possible it erodes that potential first-mover advantage they're aiming for.
Okay, before we summarize, we should probably just touch on those speculative rumors that keep popping up, the things traders are watching.
Right, the whispers. There are two main ones floating around according to the source material. First, persistent rumors that a major car company might actually launch a commercial EV model using Quantumscape batteries within the next, say, 2 quarters.
Wow, that would be huge. Like immediate, undeniable validation if that happened.
Massive. The second is the ongoing chatter about a potential takeover, either a full buyout or maybe a major strategic investment by an automotive giant wanting to lock down this solid-state tech for themselves.
Always a possibility with promising pre-revenue tech companies.
Indeed. So let's try to bring this all together into an investment thesis summary. Based purely on the sources we've gone through here, we'd have to give this an overall rating of maybe 3 out of 10.
3 out of 10, that's pretty low.
It reflects the reality. This is a highly speculative investment, full stop. It's really only suitable for capital that you can genuinely afford to lose entirely.
Yeah.
It's just not a sound investment based on current fundamentals, whether you're looking short-term or long-term right now.
Okay, a very clear stance. Let's quickly recap the positives that got them those 3 points and then the negatives that kept the score down.
Sure. On the plus side, they do have strong liquidity. That cash runway projected into late 2028 is significant. They definitely hold a unique technological position validated by that impressive 844 WHL energy density demo. And they have a visible roadmap, plus that crucial validation from the Volkswagen PowerCo partnership.
Okay, and the negatives that outweigh those.
Well, they remain stark, as you said. Zero commercial revenue is the big one. Ongoing, massive operating losses burning hundreds of millions a year. And critically, the current stock valuation just seems way out of line with the fundamental reality, and especially compared to that consensus analyst target way down at $5.88.
So success is totally dependent on flawless technical execution at massive scale, something no solid-state company has really managed easily before.
That's the bottom line. It's a huge execution challenge.
Right. That brings us to our final thought for you, the listener, to sort of chew on. We've established that Quantumscape's success really hinges on their technical execution, on making the tech work reliably at scale. But what if the biggest factor isn't just their internal execution? What if it's the external pressure? Consider how quickly the entire global EV industry needs to scale up next-gen batteries to meet really aggressive climate goals and decarbonization policies. Does that massive macro tailwind, that sheer urgency of the energy transition, does that actually reduce some of the risk? Could it force quicker adoption of promising tech like this, maybe lowering the competitive barriers slightly, or even triggering one of those rumored takeovers sooner than the fundamentals might suggest?
That's a really interesting angle. Does the external need outweigh the internal execution risk?
Exactly. Something to think about as we wait for that crucial Q3 earnings report coming up.